Investing might seem like a complex and intimidating topic filled with unfamiliar terms and market fluctuations. However, it's one of the most important building blocks for achieving financial independence and building wealth. By understanding the basic principles of investing, you can boost your confidence and feel empowered to take control of your financial future. Now, joining me to break down the basics of investing in a clear and approachable way is Oluwaseun Magreola, the head, Investment Management and Research, STL Asset Management. Thank you, Oluwaseun, for joining me today.
Good morning. Thank you very much, Perpetua, for having me.
All right, so let's begin by differentiating between, investing and saving. I mean, what's the difference?
So basically, in a layman's term, savings is simply putting funds aside in a bank account periodically to meet certain short-term goals, and could be for also emergency purposes. While investing is using your funds to acquire assets that have the potentials to grow and give you higher returns in future. So potential assets like stocks, like bonds, like mutual funds, and other financial instruments. But it comes with some level of risk depending on the assets and depending on the investment horizon. I feel those are just the basics for in terms of definition for a layman.
Okay, I guess it's the risk that probably determines, what your returns will look like. So, beyond just defining these two, I'd like you to differentiate, So if I do the savings option, what am I likely to gain at the end of the day? And then if I go for the investment options, what are the maybe pros and cons?
Okay, so for savings, to a large extent, the risk involved is relatively close to zero, because you're just setting money aside, more like a demand deposit. And that's why you earn little or nothing on it, because the investment is more demand. You can come anytime to request for your money from the bank. It's not a fixed or timed sort of investment. While on the investment side, the potential for growth is quite higher, because you can leverage on the abilities of compounding interest and the ability of reinvesting. So you can, while investing, you can combine both the principal and the interest you earn, and also invest, which is compounding, and trying to invest to earn higher returns. But basically, like I said before, for investment, it comes with some level of risk depending on the type of investment you embark upon. So some investments are very, very risky with higher returns. Like the rule of thumb is the higher the risk, the higher the return or the reward you earn on such investments. So I think those are just the sort of thin lines between both of them. But like I said before, investing comes with some level of risk, and part of the risk is you can lose all your money, depending on the type of investment you embark upon.
No, that sounded scary.
Pretty much answers it.
Okay, so I'm tempted to just jump the board and ask you, what should I do as an investor so I don't lose all the money? But I think we'll come back to that. You mentioned some instruments earlier. You talked about stocks, you talked about fixed income, you talked about mutual funds and all of that. Help us understand, these instruments, and then we'll probably zero in on one of them.
Okay, so basically there are three broad categorizations. We have the fixed income instruments, the bonds, the commercial papers, the bank placements. They have some level of returns. You have principal and some level of returns on it. We have the stock, whereby you have an ownership right, unit of ownership rights in the company which you invest in, and that is it comes with a higher level of risk, because you can lose all your money if the company doesn't perform well. Then we also have alternative investments, and these are also quite large in number. We have the real estate, commodities. You want to do even cryptocurrency, digital assets come under the alternative assets. Alternative assets or investments that don't fall under the conventional type of investment, which is fixed income and equities. So speaking to them, we also have a product that can have underlying assets in any of these three. And specific examples are ETFs and mutual funds. So for a layman, if you want to invest, if you are looking to invest, I feel you should start from the less risky type of investment before you could move into the riskier investment, just to give you some level of comfort and some level of ability, because it won't be good as a first timer you get your hands burnt while investing. You won't want to touch investing, or you'll be scared from investing in future. I don't know if that answers your question.
Absolutely. You talked about mutual funds. Can you tell us a bit about it? I think for someone who is just starting, you're not necessarily the one who is checking the updates, trying to know what's happening in the markets and all of that. With mutual funds, I guess, there are asset managers who are doing all of that for you. I'd like you to speak a bit on that.
Definitely. So for mutual fund is a pooled type of investment where the fund manager gets money from different investors and puts it in a fund and invests on their behalf. and also helps them in the day-to-day running of the fund, and also give them return periodically as stipulated by the trust deed of the mutual fund. So it could be a fixed income type of mutual fund where the underlying assets are bond. It could be a money market mutual fund where the underlying assets are money market instruments like commercial paper, treasury bills, and bank placements. It could be a balanced fund where we have a mix of both fixed income and equity investments or instruments, while we also have a pure equity play type of mutual fund. Now, the major advantage of the mutual fund is it's less risky depending on the type of underlying asset. So for money markets mutual fund, you have short-term instruments as the underlying assets, which are money market instruments. Like I said before, bank placements, commercial papers, and treasury bills, and these have zero to none type of risk attached to it. And also, one major advantage or key advantage of mutual fund is the entry level is quite easy. They are quite cheap. Some as low as 1,000 naira, as low as 5,000 naira. And it exposes you to instruments which, if you had gone individually on your own, you might not have had exposure to such instruments. So I give you an example. To play in the primary markets of treasury bill, you need about 100 million naira, 100 to 50 million naira thereabouts. Now, for a layman, you might not have such huge amount, but with your 5,000 naira in a money market fund, which is being pulled together with other funds from other investors, the fund itself can invest in a treasury bill on behalf of you guys, and whereby you'll be exposed to the return on the treasury bill. Whereas on your own, with your own fund, you might not have been able to gain exposure into those type of asset classes. So that's why we always advise starters to also start with mutual fund, which is a less riskier type of investment. And also it saves you the stress of monitoring, of day-to-day checking of the fund, because there's a portfolio manager that does that for you. Or you just monitor your price and periodically when they pay returns on such mutual funds.
Okay, let's talk a bit about the stock market.
That's basic advantage. Okay.
All right. Let's talk a bit about the stock market. I'd like you, to tell us what's the entry requirement really? Do I necessarily need a portfolio manager or a funds manager to get into that? Can't I just, get on a particular, let's say get on a firm's website and then start my journey?
So for stock market, I usually advise is knowledge driven. I usually advise you seek professional advice from your stockbroker, from your portfolio manager before you start, because it's more knowledge based. Then, to be sincere, to be candid, technology has made things a lot easier now. So there are a lot of apps where you can subscribe to and you can gain exposure to the equities market. But like I said before, it comes with a lot of risk. It's a high risk type of investment instrument. So you really need to understand how the whole cycle plays out before you get your hands burnt. But it's something you can expose yourself to leveraging on technology. That's all these investment apps we have out there. Or you can also, like I said, expose yourself through an equity-based mutual fund, which would give you a bit of safer comfort, unlike you exposing yourself fully. Because for investing in an equity-based mutual fund, you have an advantage of diversification, because the mutual fund has different type of equity instruments in it, and you can take advantage of whatever returns they earn on those individual assets by investing in the mutual fund. So for equities, like I said, it's knowledge-based. Seek professional advice first of all. Then you have to have a bit of understanding of the market, how the market play out. You need to understand how the market runs. So for the knowledge,
okay. Let me come in here.
I always advise a top-down approach. You need to understand the macro economy, you need to understand the industry specifics, then the company itself, how the company has performed over the years historically. You can read about their dividend policy. You can read about their performance, financial performance.
This is a lot of information, but I want to believe that there are people who really do not mind. I mean, they have the money and they probably will be ready to read all of this. And then when we talk about stock market, we hear that some persons are called farmers, some are called hunters, and then there are some terminologies we hear. Okay, the market's closed, bullish, bearish, and all of this. I'd like you to probably just help us understand what these things mean, and then for someone who's just starting and is considering the equities market, maybe you just help them, just some form of foundational knowledge for them to probably start. Yeah.
Okay, so for equities, when we say the market is bullish, that means the market is gaining, it has a positive momentum driving the market. Stock prices are rising. So that is bullish, it is in green territory. When it is bearish, it's the other way around, it's going down. Stock prices are depressing, the prices are going down, and there are a lot of losses in the market.
And your money is going down too.
Yeah, if you are already invested, your money is going down. But if you are yet to invest, it will be better to enter at a bearish period where prices are going down. So you can enter, because the logic is you buy low and you sell high. So you enter at low prices and you sell when the prices go up. For hunters and farmers, it's more just a terminology. For hunters, it means you are actively managing your equity investments. For farmers, it means you are adopting a passive strategy. So passive strategy, you are leveraging on some level of algorithm, which we call Fasanmi-Peter, to help you manage your funds. While for active, you are tracking day to day, you are tracking the portfolio, you are watching the performance, looking at the PE ratio, the dividend yields, and the likes to manage your investments. So those are just the two difference in the two terminologies. Hunter, you are actively managing your fund. For farming, you are passively managing your fund.
All right, so generally speaking, you were saying something?
Okay.
All right, so
No, I
generally
wanted to
speaking,
be sure if I answered your questions.
absolutely, you did. Generally speaking, help us just wrap this up. Basically, just maybe a thought, just leave a thought for someone who is just about to start investing, to start his or her investment journey. Just a thought.
A thought. So basically, like I always advise, a rule of thumb, investing is good. It's better to invest than to save because you get higher returns. But to invest, you need to start from safe asset classes. You need to start from less risky asset classes and build that confidence, build that momentum over time before you dive into risky assets. And definitely risky assets will give you higher returns. So, but it's not so good as a learner, as a first timer, to just jump into risky assets. You will get burnt. And also seek knowledge, which is key. The key fundamentals driving the market, whichever market you want to play in. You need to seek professional knowledge. You need to research. You need to have that knowledge, because knowledge is what drives the market. If you understand what you are doing, you have that confidence, and there will be less risk in terms of your risk appetite will be quite increased. Your ability to absorb, because you understand what you are doing. We have a lot of people that are investing without the basic knowledge of what they are investing in. And when they get burnt or when the market is down, they run high blood pressure. But once you understand what you're investing, even when things are down, you understand the fundamentals already, and you know this market is a cyclical play. Things go up, things come down, and it has its seasons and periods where
All
you
right,
can take advantage of.
Oluwaseun, thank you so much for your thoughts. I feel this stock conversation is something we'll probably have another time so we can better understand how it works. Thank you so much, Oluwaseun Magreola, Head Investment Management and Research, STL Asset Management. Thanks for your time.
You're welcome. Thank you very much.